So this is the final lecture in my series of lectures this year. And these lectures have been about the big ideas of finance. And so I've talked about 5 of those ideas already. And this is the final idea, the idea of market efficiency. Right? So all these ideas, as I've always noted and before all my lectures, and this is a plug, is basically taken from my textbook, which has 6 chapters, 1 for every idea of finance. So everything I talk about comes straight from there. Anyway, so what are these 6 ideas? The first idea of finance was that of net present value. This is probably the only idea of finance which did not win a Nobel Prize, mainly because it's so obvious that people said, well, you can't pretend to have, claimed to invent it. So that's an idea which no Nobel Prize was given. But the others, 5, have won Nobel Prizes. So the second idea of finance, portfolio theory and the capital asset pricing model, got a Nobel Prize for Markowitz and Sharpe. The third idea of capital structure theory, Nobel Prize for Modigliani and Miller. The fourth idea, option pricing, Scholz and Merton. The fifth idea, which we covered last time, asymmetric information, was Akerlof, Spence, and Stiglitz. But today's idea, the sixth one, market efficiency, lots of people have won Nobel Prizes for this. And what's especially interesting is they won Nobel Prizes in several cases for saying exactly the opposite things from each other. So, for example, Kahneman is a behavioral psychologist, who was the first psychologist to get a Nobel Prize in economics. He said that people act weirdly in markets, and that affects prices. Farmer and Schiller got it in the same year, in 2013, for saying exactly opposite things. Farmer said, the market is completely efficient, we don't need to worry about psychology, this is the way we can treat everybody as completely rational. Schiller got it for saying, well, people are crazy, and crazy people affect the market as well. This is the same year, right? So they're both getting Nobel Prizes, sharing the Nobel Prize for saying completely opposite things. Taylor got it a few years later for saying that Schiller was right. So who is right? Well, today I'm going to talk about Farmer's idea. Next year's series of lectures will talk more about Schiller and Taylor. Okay. So what are these other 5 ideas? At its core, if you remember, finance is just one simple story. The question is, somebody comes to you and says, I want you to give me some money today, and in return, I'm going to give you possibly a huge amount of money tomorrow, or next year, or 100 years from now, or whenever. The point is, you have to pay the money today, but you'll get the money in the distant future. So the question of finance is, how much is this promise worth? That's all we want to find out. Right? So how do you figure out the value of a promise? The first idea of net present value comes precisely to find out the value of that promise. So it tells you, if you promise something 5 years from now, what's the present value of that? And you compare it to the value you're going to pay today. If I'm asked to pay £100, but I'm going to get back less than £100 in the future, I don't invest. If I get back more than £100, I invest. That's very straightforward, common sense. Invest only if you get back more than you spent. Right? Makes sense. There's a general formula for that. The problem with the general formula is, to get those numbers back from the future to today, you need a discount rate. You need an interest rate. So that's the second idea of finance. The second idea of finance asks us, what's the right discount rate to use? And remember, the people who came up with this idea were Markowitz and Sharpe, and they got a Nobel Prize for this. So what did they say? They said, if people come to you and ask you to invest in a company, what do you need to ask yourself? You need to say, why should I give money to this guy? I mean, what else could I have done with my money? In other words, what's my opportunity cost of investing in this company? By investing in these guys, I've given up the opportunity to invest in something else. So the return on that something else should be the return which I'm going to discount these cash flows. Fine. But that opportunity should have the same level of risk. What is that level of risk? Well, Markowitz and Sharpe said, the idea is that everybody who is smart holds a market portfolio. We hold a portfolio consisting of every diversified asset in the world. So the risk is the covariance with that market portfolio. That's called the beta. And the CAPM just says the discount rate is the risk-free rate plus the beta times the market risk premium. This will be covered in the second lecture. The third one goes back to the company, says, how much should a company borrow? They have multiple ways of raising capital. They can issue equity, they can go to the bank and they can borrow money, they can use their own retained earnings. What's the best thing to do? Mulliglani and Miller said, in a perfect world, with no taxes, no government, no lawyers, that's a perfect world. In that case, it doesn't matter how you finance your investment. In a not-so-perfect world, taxes, you should borrow as much as you can. But firms don't borrow as much as they can. Why not? Because of yet another imperfection, those are lawyers. So if you have lawyers, unfortunately, firms go bankrupt, there's a cost of financial distress, so firms trade off the cost of financial distress against the benefits of taking on a tax shield. The fourth idea of finance is about options. So what's your ability to change your mind, right? So someone comes to you and says, give me money, and I will give you back money in the future. So what you want to say is, can I put in a contract that if I get more information, I want my money back before the term comes through? So what is the value of being able to change your mind once you have made that investment? That's the idea of options. They are contingent investments. They're contingent on something else happening, right? So that's the question. And the thing is, can you change your mind after making the investment? Or can you wait to make up your mind till you get more information? Now, what are the two common assumptions behind all these ideas? One assumption is everybody has the same information. The second assumption is everyone analyzes the information in the same way. So in my last lecture on asymmetric information, I relaxed the first assumption. That is, not everybody has the same information. People have different levels of information. That's why it's called asymmetric information. In a world with asymmetric information, what we showed was the people who are hurt by asymmetric information are not the people with less information. That's because the people with less information know they have less information. So they won't pay full price for anything. They'll pay the average price between the good players and the bad products. So the people who are hurt are the people with more information and a superior product because they're unable to convince the less informed people that they indeed have a superior product. So the ones who love asymmetric information are the ones with more information and an inferior product because they're pretending to have a superior product in order to sell their stuff. And so good players use signaling to distinguish themselves from the bad players. And of course, if you're less informed, use screening to distinguish them. That was everything we have done in the last 5 lectures. So what are we going to do today? Well, we're going to relax the second assumption. The second assumption, remember, was that everyone analyzes information in the same way. So what does market efficiency mean? This is a cover taken from The Economist in November 1997 after the Southeast Asian crisis. And The Economist basically said, well, this guy is on the phone. He says, I've got a stock here that could really excel. Somebody overhears him. Really excel? Excel? Excel sounds like sell. So everybody panics. The markets panic saying sell, and market prices crash. Somebody says, this is madness. Can't take any more. Goodbye. Sounds like buy. Everybody goes crazy screaming buy. So the question is that what the market is like? Is that a market? Or are people careful, rational human beings who calculate NPV, do all the steps in finance we have talked about for the past 5 minutes, and apply them appropriately? That's what we want to find out today. So what did academics think before 1960? Why 1960? 1960 is where modern finance began. Before 1960, we were just like the other areas of management, strategy, organizational behavior. Well, if my colleagues are listening to this on YouTube, I apologize, but they never watch finance videos, so I'm usually safe. But anyway, but before 1960s, we didn't have a way of thinking about these issues. We just basically said, we describe what people do, but we didn't have a theory. So what we were describing, what did people do to analyze companies? There were 2 approaches. Approach 1 was what we call fundamental analysis. What fundamental analysis means is simple. You sit in front of giant computers, like this one. You analyze the companies in excruciating detail. You figure out like balance sheets, you figure out the income statements, you figure out everything about them. And then you compute the true value of their shares. If the value of their shares is high, but the market price is low, you buy. Otherwise, you sell. Pretty straightforward. It's called fundamental analysis. The big proponent of this was actually two people in 1934 who wrote a book called Security Analysis. That book is in print even today. Right? And Warren Buffett wrote written a foreword for the latest edition. That's because he was a student of Ben Graham, and he attributes all his success to Ben Graham. This is one of the richest people in the world, and he says, that's what you need to do. This is the approach you need to follow. But then you have another group of people who basically do something called technical analysis, also known as charting. The idea here is, I don't need to know anything about a company. I don't care who the CEO is. I don't care what business model they have. I care about nothing. All I do is, I set up a computer, like this guy over here, who's stealing his daughter's breakfast, but he's basically written a coding program where all he does is to analyze prices. And he sees patterns in prices. Can I find a pattern? Can I trade on it? Can I make money? Literally, it's all automated. You're not doing anything at all. The computer is doing it all for you. The computer needs to know nothing about the company. It just looks at prices. So these were the two big approaches. And until the 1960s, as I said, we had very little to add. But what happened in the 1960s? Well, the first thing was, in economics, we came up with this concept of general equilibrium. What general equilibrium meant was, we would take into account people's reactions when deciding how to react. In other words, I need to figure out, in any interaction, how you're going to react. I'm going to figure out how you're going to react, thinking about how I'm going to react. I'm going to figure out how I'm going to react, knowing that you're going to react to how I'm thinking you're going to react, and it goes on forever. To give you a sense of that, let me start by asking you guys a question. Let's suppose you have a stock price that can range anywhere, uniformly, between 0 and 100. Right? Could be anywhere. All you have to do is to choose a number that is closest to 2/3 of the average of all the numbers chosen in this room. What that means is, if everybody chooses 100, if your number is 66, you win. But if everybody chooses 66, you have to be close to 44 in order to win. If everybody is 50, your number has to be 33 in order to win. You guys ready to play? Okay, let's do it. Go ahead, use the scan on your phone, and then drag your number to anywhere between 0 and 100, and tell me what you will pick. You multiply all the numbers by 100, so this is like 24. Excellent. So we have about 45 responses here, 47. Very nice. Of course, if you're an economist, there's only one right answer. That's 0. Why 0? Because the idea is you're anticipating what everybody is doing. So if everybody does 100, you have to do 66. But if you're one level smarter, you say, well, everybody's going to think that way, so they're going to vote 66. I'm going to go 2/3 of 66, 44. The third level person will say, I know everybody's going to do 2 levels, they're going to do 44, so I'll do 2/3 of that. And you have to do this backwards until literally the only equilibrium number is 0. As you can see, nobody thinks that way, except economists. Right? So the question here is, are we economists in the sense that we carefully analyze everything. Are we human beings? In this lecture, I'm going to talk about us being automatons, basically economists who think this way, and I'll give you a reason why we believe that's the case. So coming back in here, what this is basically saying is, the nice bit about general equilibrium theory is that it involves heavy-duty math. And math is a really good topic. Why? Because no one can understand it. So if you're an economist and you use heavy-duty math, people will say, wow, this guy's so smart. They won't question you. So you can charge high salaries. That's when finance took off as a respectable academic field. And that's when finance professors began to make more money than any other professor because nobody could understand what we were saying. So that's the development of modern finance. Okay, so general equilibrium theory at that point made finance a respectable field. And the idea was, in a market like this, where everybody is smart and everybody is analyzing everybody's behavior, what's happening is that it's a market with perfect competition. And in a perfectly competitive market, there is no such thing as a free lunch. This is something I mentioned in my first lecture last year, and I'm coming back to that today in the final lecture. No free lunch. This was the basic idea behind market efficiency. No one gives you something for nothing. So, what is the definition of an efficient capital market? The answer is Pharma's definition. Pharma basically said, an efficient capital market is a market that's efficient in processing information. That means the price of any security at any time is the value of all the information available at that time. That means the market price will reflect only the available information. This is an interesting definition. And of course, not everybody believes that. Warren Buffett said, I'd be a bum in the street begging with a tin cup if markets were efficient. So he did not get to be the smartest, one of the richest people in the world with, apparently believing in market efficiency. But we leave that to a side for a second. Let me start with an example. Let's suppose you have a company, the WhatsApp company, which is developing a new bulb which will have double the lifespan of bulbs currently available in the market. Right? So, but it's having problems developing the bulb. The question at this stage is, what will the price of a share in the company depend on? Right? Obviously, it will depend on the probability that the new bulb will be developed. Right? The higher the probability, the more people will be willing to pay for a share in this company, the sharing in the profits of this company when the company eventually develops a bulb. Right? Common sense. All right. Now, today, June the 10th, the company announces that a well-known professor will join the company on leave from his university for 1 year on January 1st, 2025, in order to help develop the bulb. All right? The good news is that professor will improve the chances the bulb will be brought to market 1 year early. So the professor joins, super smart guy, the bulb will be developed 1 year faster than before. The question for you at this stage is this good or bad news for the company? What do you think? Go ahead and vote. Keep your phones open. I'm going to ask a lot of questions. Okay, the dominant answer is, indeed, that it's good news. And it's probably most likely good news, right? I mean, the guy is an expert. He's going to develop the bulb faster. Good news. Which means, if you're an investor, should you buy the shares or not? Obviously, you should, right? So which means the share price should go up. That's okay. The question for us is, when does that increase happen? The 3 dates. Date number 1, today. Professor hasn't joined the company. Nothing has happened. Professor hasn't joined the company. He hasn't developed anything. Nothing. Okay? Date number 2, January 1st next year. The professor had just joined the company, but hasn't actually got around to developing the bulb. And then the third date is January 1st, 2 years from now. The professor has been with the firm for 1 year and has successfully developed the bulb. All right? So the question for you is, when do you expect the share price to go up? So 3 dates. Today, January 1st next year, when the professor joins, January 1st, 2 years from now, when the professor actually gets around to developing the bulb. Excellent. So quite a few answers, most of them saying today, but some saying 1 year from now, 2 years from now. Oh, okay. Let's see what market efficiency means. Right? Let's suppose, indeed, that this is the right answer. So that means 2 years from now, the professor has developed the bulb. The price should go up. But if you're smart, when do you buy the share? You don't buy it on January 1st. You buy it on December 31st, because the other guys will buy the share on January 1st. You buy it 1 day early, so you make money. If you're smarter, you buy it on December 30th. If you're even smarter, December 29th. And in fact, you wind your way backwards until, literally, that's the only day when you can even hope to make money. Right? If you wait even 1 day, it's gone. It's too late. Somebody else has already bought the shares before you. The share price has gone up. Okay? So the idea again here is, remember, what's so special about today? Nothing. The professor hasn't joined. There is no new bulb being developed. Nothing has happened. The only thing that's happened is the information about the professor has reached the market. That's Farmer's definition. Prices react to information, not to the event. What happens on January 1st when the professor joins? Nothing, because all the information is right there. You don't need the guy to actually develop the bulb to actually buy the shares. Right? If new information comes out, the bulb is not as good as before, something else has replaced the bulb, then the price will change again. But again, it's changing on the basis of information, not on the actual event. That's the idea of market efficiency. Okay. So, an alternative definition of market efficiency is very simple. In an efficient market, it's impossible to consistently make abnormal returns on the basis of information. Okay, how does this definition make you feel? Let me ask you that. It's impossible to make money on the basis of information. A lot of people don't really care about it one way or the other. Fine, that's good. These are economists. No, I'm kidding. Okay, excellent. So we see quite a few people are sad, and indeed, it is a sad thing, right? I mean, why are we studying finance if there is no way to make money in the market? What's the point? Why don't we just have a good time, right? Finance is a good time, but, better times. Okay, so if you ask the question, do you like the efficient market hypothesis, most people will say, no way, this is very dismal. This is basically saying there's no way to consistently make money if the market's efficient. Right? Unfortunately, not everybody believes this, apart from classical finance professors. Otherwise, you wouldn't have people out there on the Wall Street and other places desperately trying to make money. Right? So why does not everybody wholeheartedly believe in this story of market efficiency? One is, of course, the truth is much less interesting. Right? If you say, I made a lot of money in the market, why did you make money? Stuff happens. Sometimes you make money, sometimes you lose money. People don't like that kind of explanation. We like to believe there's a reason for everything we do. There's some meaning in what we do. Shit happens is not a good reason why most people like to believe, right? The truth is much less interesting. The second thing, of course, is there are lots of patterns. We find patterns everywhere. Human beings are pattern detecting machines. For example, How many of you have ever looked up at the clouds and said, oh, that looks like a person with a big nose, or that looks like an elephant? Anybody? Right? We all do this all the time. We like finding patterns in everything. So, and stock prices are beautiful places to find patterns on. Like even astrology. I remember on my last flight back from India, I was reading Cosmopolitan magazine. It wasn't my magazine, it was the magazine in the seat next to me, someone else. No, I'm kidding. It was somebody else's magazine, all right? Not there's anything wrong with reading Cosmo. But anyway, so I was looking at my own horoscope, and I was taken aback. It described me perfectly. Everything about me was there. I was kind-hearted, I was good, I was generous. I was like, that's just me. But then I realized I was reading the wrong page, so it wasn't my horoscope. But every horoscope described me, so I was fine. Anyway, let's take an example. This is the VIX index, the CBOE volatility index. Can you see a pattern? I show it to you right here. What does that look like? Superhero movie? Batman, right? That's a rare Batman pattern in the stock market. Okay, but you can find these patterns everywhere. So here's another example. This guy was extremely annoyed at the Guptas who were running South Africa. So he set up two accounts in a very thinly traded account for his own company, and he started buying and selling shares to give a big middle finger to the CEO of the company. Right? And he was arrested as he was drawing the bottom half of that and put 100,000 rand fine. But yeah, you can find patterns everywhere. But wait a minute. We know of traders who made lots of money, right? For example, George Soros. It's well known that in 1992, Britain was trying to join the European Monetary Union. As eventually we had the euro instead of having the pound. Unfortunately, George Soros felt that the Bank of England had set too high an exchange rate for the pound. Right? So what he said was, I'm going to sell the pound to drive the price down and buy foreign exchange. The Bank of England was trying to protect themselves, so they decided to buy the pound to keep the value up and sell foreign exchange. The Bank of England ran out of money before George Soros did. So Britain crashed out of the European Monetary Union, which meant that we'd never replace the euro with the pound, which then led to Brexit, and then where we are. But anyway, he himself made £1 billion that year. Okay? That's one example. Warren Buffett, if you had invested $100 in Berkshire Hathaway in 1965, that would have been worth, in 2014, $1.8 million. 100 becomes $1.8 million. If you'd invested in the entire stock market, that would have been about $11,000. This is way better. This guy has beaten the market for nearly 30 years. Unbelievable. Or John Paulson. John Paulson was a sort of also ran on Wall Street until he realized in 2008 that the market was overvalued. The housing market in particular was very highly valued. So he created instruments to short houses. And what happened? He made a ton of money when the housing market collapsed. How much money did he make? $3.7 billion. Right? Now, for most of us, we think about billions of dollars and like, what the hell is $1 billion? It's very difficult to visualize this number. So the way I like to think about it is very simple. Suppose I were to give you $1 million, okay? Happy? Right. All right. Now I want you to go out and spend $1,000 a day. Can you do it? Probably. Okay. But you can't take any time off. Even if you're ill and you're saying, today I just want to stay in bed. Sorry, that's not an option. You have to spend $1,000 a day. You do that? Of course. Excellent. This is my man. All right, fine. It means if I give him $1 million, it would take him 3 years to get through the money. With $1 billion, it would take him 3,000 years to get through the money, spending $1,000 a day. This guy earned $3.7 billion in 1 year. Right? So that's 12,000 years of spending $1,000 a day. And while he's spending the money, of course, the remaining money is earning interest. So he literally never runs out of money, regardless of how much he spends. That's 1 year's salary. But other people are there too. George Soros, $2.9 billion that year. Let's take year after year. This is 2012. Look at the names on that list. Here you have some names: Ken Griffin, Steve Cohen, John Griffin, Andreas Halvorson, Philip Falcone, James Simmons. Names. Okay, let's look at some names there. Ken Griffin, James Simmons, Steve Cohen, Ray Dalio, David Tepper, David Shaw. These are the amount of money they earn on an annual basis. 2.2 billion, 1.7 billion, 1.4 billion. 2014, Steve Cohen, Ray Dalio, George Soros, Ken Griffin, James Simmons, same people. Again, billions of dollars. 2015, Ken Griffin, James Simmons, Steve Cohen, Dave Tepper, David Shaw. Oh, 2020, Jim Simmons, Ken Griffin, Steve Cohen, you've got Andreas Halvorson, David Shaw. Literally, every single year, these guys are earning several billion dollars per year. And remember, each year is 3,000 years of spending $1,000 a day. Right? So this is the top 20 in 2022. So the question is, how am I saying the market is efficient? You can't make money, and these guys are making billions of dollars every year. What's going on? How do I reconcile these two together? So what have we done in finance? What we have said is the efficient market hypothesis, the NPV and stuff we did right in the beginning, said that investors need to find the value of something, the expected cash flows divided by 1 plus the discount rate. And they have an expected discount rate over there. They plug it in. The problem with the definition is it doesn't tell you what is the expected return to use. It just says whatever the market uses is right. So in other words, the EMA just says the market value is the best available estimate of the true value that can be made using the information set. If we don't know what the information set is, we cannot deny that P is equal to P star. So let's get back to this. So when are markets efficient? 3 conditions. Condition number 1, everybody is irrational. Everybody uses the NPV. Everybody uses the CAPM. Everybody uses all the ideas in finance we have done so far. Second, sometimes people are crazy. They're over-optimistic or over-pessimistic. No problem, as long as they don't behave the same way at the same time. I mean, some people are optimistic, some people are pessimistic. They'll cancel each other out. So that means that everybody has to behave the same way at the same time. Everybody has to buy shares together. Everybody has to sell shares together. That means even if they're irrational, they all behave in the same way, the smart arbitrageurs, the big guys, like George Soros, like Steve Cohen, all these guys step into the market on the other side, and they make the money. Okay? So 3 big stories over here. So let's go back to that definition. Impossible, consistently make abnormal returns on the basis of information. Impossible doesn't say that you can never make money. You can. Every now and then, you might make money. The point is, it shouldn't be your day job. That means you're not going to do it every day. It's like buying, if you want tickets to Taylor Swift, for example, maybe you'll be getting it now and then, but you won't get it every single concert which she comes to town. Right? That's the idea. So those are the words, impossible and consistently. But also let's look at the word abnormal. Abnormal just says returns that beat a benchmark, like the CAPM, which we've talked about. So for example, if you make 10% returns in this market, are you doing well? Answer is, we don't know. The 10% is meaningless unless you have a benchmark. If the benchmark says the market made 5%, but you made 10, it's great. But maybe the market made 20 and you made 10, that's not so good. So 10% without an appropriate benchmark means nothing. So you have to have the benchmark correct in order to make a conjecture on what you do. But the most important part is information. And I'm going to talk about 3 types of information. They're nested within each other. The first one is all information in past prices. Second is all publicly available information. Third one is all public or private information, any kind of information at all. And there are 3 definitions of market efficiency. The first one is weak form. It says, if you have any information on past prices, ignore it. It's not going to make you any money. Second one says, if you have any public information about a company, forget it. That won't make you any money either. And strong form market efficiency says, it doesn't matter what information you have. You'll never make any money. Full stop. Let's look at each of this and see how we prove it. So weak form market efficiency is a rule which says something like, if the stock price drops abruptly, I wanted to buy the stock, it's looking cheap, let's buy it. It's like a sale for shoes in a supermarket. Stock prices are not like that. Just because there's a sale, it doesn't mean it's a sale. Right? So basically, these are totally useless. So let's see how we can actually show this. This is a biological graph on body mass index and body fat. What does this graph say? This graph says there's a positive relationship between body mass index and body fat. Higher body mass index, higher body fat. Right? That's a typical pattern which you find in biology. How would you translate that into finance? Well, you'd have returns today, returns tomorrow. If you see this pattern existing, what should you say? High returns today, buy because the returns tomorrow will be high. Low returns today, sell because the returns tomorrow will be low. That's what you should see if you have returns today and returns tomorrow, and if something like this. Does a pattern like this exist? This is the S&P 500. Returns today versus returns tomorrow. Can you see a pattern? No way, right? If you saw a pattern, the market would not be efficient because you can trade on that pattern to make money. Now, this is two dimensions, return today, return tomorrow. But maybe return last week was important. Maybe return 3 days ago was important. How do we test more than two dimensions? Answer, we use a regression. What does a regression look like? Return is expected return, that's your benchmark, plus some past return. So it is RT minus 1 is return in some previous period. The question is, can I use the return in a previous period to explain my return tomorrow? Of course, if you don't like this, you can have more complicated regressions. Return yesterday, return 2 days ago. You can have even more complicated regression. Square that term there. Doesn't matter what you do. If the market's efficient in the weak form, none of this stuff should be able to explain that, which means that all you're testing for is this gamma is equal to 0. Very straightforward test, and Farmer did that in 1970. This is the table he did. He did this by hand, by the way, because there were no computers in those days. So it's a lot of effort, and that's why he deserved the Nobel Prize 30 years later, 40 years later. Right? But what you can see is most of the numbers are close to 0. That means past returns do not predict future returns. And people tried all sorts of complicated things. They looked at things like a cup and a handle pattern. If you see a cup and then a handle, the price will go up later. Doesn't work. They saw things like a death cross. The 200-day moving average goes above the 50-day moving average. Doesn't work. Don't believe any of these signals. None of them make money. Okay? So now let's talk about semi-strong form market efficiency. What this says is any information, any public information about the firm. So that should be there in the stock price. Let's take an example. The Titanic. Right? The Titanic sank on April 14th, 1912. Quick question for you guys. How much did you like the movie? Excellent. So a lot of people love the movie. Most people sort of 3.5, which is pretty good. I myself hated the movie, absolutely hated the movie. Why? Anybody? Well, no, because they left out the most important thing. What was the most important thing? The stock price reaction. They never talked about it even once. It was crazy. I was looking through the movie like, wait a minute, what happened in the markets? Not once. But what happened in the market was actually very cool. So it sank on April 14th, 1912. No cell phones, no Twitter, no WeChat, no way of communication. And the ship's owner, the International Mercantile Marine Corporation, had spent $7.5 million to build the Titanic. But it had insurance for only $5.5 million. Within 2 days of the ship going down in the middle of the Atlantic Ocean, 2 days, the stock price dropped by $2.5 million. $2 million is exactly the loss of insurance, $500,000 maybe for the extra amount they lost. Who wants to go on a ship built by the IMF, right? So that's, right. I thought that's so cool, but it didn't mention in the movie even once. Pathetic. Okay, more generally, in a semi-strong form efficient market, what you're looking for is basically nothing happening, information is released, the price should react instantly, and then nothing should happen after that. If the price goes up slowly, a delayed reaction, you can make money. If the price overreacts and corrects, you can make money. The point about finances, market efficiency especially, is no free lunch. So you should never be able to make money on the basis of any of these things. That means the only thing which is consistent with an efficient market is this. That's it. Or, of course, this. Right? Good news or bad news. But you should never see anything before or after. So let's take a look. So this is from a paper written by Jeff Buss and Cliff Green called Market Efficiency in Real Time. What these guys did was to look at CNBC's midday call, and it's a segment hosted by Maria Bartiromo. And in this particular case, she does this every day, and she was talking about a particular company. Every day she talks about a company. What you have on the left-hand side will be her talking about this company called Alza, right? The word Alza over there. On the right-hand side, you're going to see the white dots are the prices. What I'd like you to do is get ready with your stopwatches on your phone. She's going to mention the word Alza on the left-hand side. I want you to tell me how fast it is before the stock price reacts. How many minutes, how many seconds, how many hours is it before the stock price reacts? Okay? Everybody ready? Oops, sorry. Okay.
And in today's midday call on Wall Street, Bank of America Securities is telling clients today that early sales are strong for pharmaceutical company Alza's new drug to treat attention deficit hyperactivity disorder. The drug is called Concerta, and it launched on August 21st. The Bank of America analyst, Jerry Treppel, has been tracking the launch on a daily basis. He says in the midday meeting at Bank of America that Concerta prescriptions have already surpassed Novartis's extended-release version of Ritalin, which was quite successful. He's forecasting $50 million in sales this year and says that he expects peak sales potential in excess of $300 million.
How much time was that? 23 seconds. Right? That's how efficient the market is. You have less than a minute before the price reacts to information. That's why we say markets are efficient in a semi-strong form. Another way of looking at this is by looking at precisely those guys who are making so much money, mutual fund managers. Right? Remember, mutual fund managers do not claim they have insider information. If they traded on insider information, they were put in jail. Right? So they're not allowed to do that. So they say we have only public information, and we're going to analyze it better than anybody. So how do we know whether these guys actually beat the market or not? Well, the answer is very straightforward, same regression. What you have, the return, you have that benchmark, whatever benchmark they're having, and then you want to look at whether they earn a positive alpha, a return above the benchmark. If they earn a return above the benchmark, they're beating the market. The market is not efficient. So the question is alpha positive or negative? If it's negative, that's not a problem because they're losing money, and that's totally fine. If it's zero, not a problem. They're earning in line with the benchmark. But alpha positive means they're beating the benchmark. So the first study did this was 1969 by Michael Jensen, and he said, do they have a positive alpha? And what he found, he did with 115 mutual funds, ran 115 regressions to get 115 alphas. Most alphas were around zero. Before expenses, the average alpha was negative. After expenses, it was even more negative. He said there is zero evidence of fund manager skill. This was 1969. Maybe stuff has changed. Maybe things are getting better. Answer, no. Right? So if you look at even the latest evidence, if you go back to the CAPM line, that was the line we talked about in part in the second lecture, most of these guys are below the line, which means they're earning returns which are less than predicted by their benchmark. They're not making money. They're earning less than you would have got had you invested in the benchmark yourself. So maybe some fund managers do well. So this is another study which looked at if you beat your benchmark by 1 year, what's the chance you're going to beat your benchmark by in the second year? Answer, 50% chance. You beat your benchmark 2 years in a row. What's the chance you're going to beat your benchmark in year 3? 52%. You beat your benchmark 5 years in a row. What's the chance you're going to beat your benchmark in the 6th year? 46%. So, what kind of game gives you a 50% chance of winning and a 50% chance of losing? Anybody? A coin toss. So let's evaluate mutual fund performance using a different approach. Luck. Okay? Let's line up every investor in the world. And there are lots of them, right? There's 7.5 billion people today. So about 1.5 billion in China, 1.5 billion in India, people around the world. And take everybody who's invested in the stock market, probably about 1 billion people. Line them up, toss a coin. If you get heads, you stay in the market. Get tails, you leave the market. Everybody okay? So, year 1. 1 billion becomes 500 million, 250 million, 125 million, 62 million, 31 million, 15 million, 7.5 million, 4 million, 2 million, 1 million. 10 years later, you got 1 million people who have tossed heads 10 times in a row. Pure luck. You do this again. 1 million, 500,000. 500,000, 250, 62.5, 31.5, 15, 7.5, 4, 2, 1. 20 times in a row, you have 1,000 people who have tossed heads. If you go to 30 years in a row, you could have 1 person who have done that. 30 years in a row. You're guaranteed to have a Warren Buffett by pure luck. It's just the pure number of people who are participating in the market. You have to have somebody who just beat the market. There's nothing inconsistent with luck in that story. Okay, but wait. This is just, I'm telling you the story. I did work in the fund industry, and I've got to say I didn't perform very well. That's why I'm an economist and not a fund manager. Maybe I have no clue. Right? How, as a professor, though, how might I tell who's the smartest student in my class? Right? One way I might do this is by looking at which student every other student is copying the answers from. Answer is, I don't know who the smartest one is, but the kids know who the smartest one is. So the question is, maybe other mutual fund managers can detect the superior guys. I'm an economist. I don't talk to these guys. But these guys hang out in bars and say, oh yeah, if you want a mutual fund manager, that man's a god. Right? So, question is, do they know who these fund managers are? So, there's a study, which is done by a brilliant professor at Cambridge, that's me, sorry. But anyway, what we did was to look at every mutual fund manager in the market, and we saw which fund manager copied everybody else. So, in other words, there's a gap of 1/4 between your holdings and the other holdings. And we said, how are these guys basing their information? If these guys really know who the good managers are, the guys whom they're copying should outperform. They don't find that. What we find is the guys who are being copied are the guys who did well in the past. Precisely the same things we use to try to figure out what a fund manager is, good or bad. Past information, which doesn't tell you anything about future information. So, they don't know, we don't know. Right? Let's give you a last problem. It's 1943. You're working with a statistical research group here in England, and planes are flying over Germany to bomb Germany. Attrition rate is very high. Most planes do not come back. So your job is to put armor on the plane. The problem with armor is heavy. Put too much armor, the plane crashes. Put too little armor, the plane gets shot down. You have to put armor in precisely the right spots. So you notice that on the planes that come back from Germany, the engines have 12 bullet holes. The main body of the plane, the fuselage, has 39 bullet holes. The wings have 18 bullet holes. The tail has 25 bullet holes. So, where do you choose to put the extra armor? The fuselage, maximum number of bullet holes. The engines, minimum number of bullet holes. The wings, or the tail. Just basing it on the evidence which you have. Okay? This, by the way, is precisely the origin of the word survivorship bias. Because what you're seeing here are the planes that come back, the survivors. So the survivors, if you have 13 bullet holes in your engine, what happens? Your plane never comes back. You have 30 bullet holes in your main body, the plane comes back. So the main body is much less vulnerable than the engines. The engines can bear the least number of bullet holes before you never see them again. The sample consists of only the planes that came back. You never see the planes that were shot down over Germany. So in other words, for us, if you look at a sample of great investors consistently outperform the market and we conclude the market is not efficient, you're drawing the wrong conclusion. We're looking at the survivors. We don't look at the millions of people who started and never made it. Right? So, in other words, we don't need to know that Warren Buffett beat the market for 30 years. He could have done it any number of ways. We need to know who the next Warren Buffett is. And unfortunately, nobody knows the answer to that question. So, let's go back to these great investors. There are two parts to this. So this was a graph I showed you before. And the two parts is the yellow part and the pink part. The yellow part is their performance fees. And the pink part are the gains on their personal investment. What does that mean? Well, let's take a look at, say, even 2021. Look at Ken Griffin. The green stuff is the fund performance fees. The pink stuff is gains on personal investment. What that means is every year when they say these guys made billions of dollars, there are two parts to it. One is the money he made running his fund. The other is the money he made on the previous billions of dollars he already had. And even if you earn 1% on $1 billion, that's a ton of money. So, moral of the story is, how do you get to be a billion? How do we get to be a billionaire? Start with $1 billion. That's why they say the first billion, that's always the hardest. Okay, so the last part is strong form market efficiency. What that basically says, any kind of information, public or private, is in the market price. How is that possible? It's private information. Nobody knows this. Let's take an example. Let's say we're in Cambridge, right? And I need a couple of people. Would you like to be a volunteer? Okay, so you're the CEO of a company, okay? And I have here somebody who wants to be the CFO of the same company. Now, I have to point out, Hugh Purser is a friend of mine, and he is also a black belt in Aikido. He's a big, huge guy. He's terrifying on the dojo floor. So he's your CFO, okay? Anyway, you're both going for a punting trip on the cam, and Hugh confesses to you. He says, look, the company is losing money, and by sheer coincidence, I've taken the last £1 million of the firm's money, and I have it in a bag right here. I'm telling you this because you're a friend. I am going to, the punt arrives on the other side. I've got a taxi waiting for me. The taxi will take me to the airport. I'm going to South America. You will never see me again. Now, this is private information. She's the only person who's heard this. It's in a punt in the middle of the River Cam. No one else has ever heard this information. How does it get into the stock price? Like, if your market is efficient in a strong form, it should be there in the stock price. But how? He's gone off to South America. She can't, he's a big guy. She can't, hopefully, are you a black belt at something? No. Okay, so you can't hold him down and keep him there till the police arrive. So he's gone with the money, right? No one's going to hear from him. How does your information get into the stock price? The answer is, if insider trading is not illegal at that time, all you have to do is, she calls a broker. She says, sell all my shares right now. But what does the broker say? The broker says, wait, she's the CEO. The CEO is desperate to unload her shares. Is this good news or bad news? Definitely bad news, right? So even before the broker executes her order, what's the first thing the broker is going to do? Sell all his own shares. Call all his friends to tell their shares. It doesn't matter what the information is. The moment you recognize an insider is buying or selling, that's information for the market, right? That's why the market might be efficient in the strong form. Unfortunately, most insiders are trying not to be dumb. They sell their shares through, friends, family, whatever. So it's difficult to find, difficult to find cases when it's obvious that this is an insider who's trading. And that's why insiders do make money, which is why it's also illegal. Right? So that's the one thing which you cannot stop. But semi-strong form market efficiency, you can pretty much say, yes, the market's efficient. Weak form market efficiency, you can say, yes, the market's efficient. But strong form insider information will still make you money, and that's why you should not do it, because you'll get put in jail. Okay, so big takeaway For a long time, finance academics thought the market was efficient. Competition between traders would drive prices to fundamental values, and irrational traders would be completely driven out of the market. Unfortunately, many people are realizing now that this is not true. Investors make systematic mistakes, and they affect prices in ways that are difficult to predict. That will be the subject of my next year's series of lectures, where I talk about the human side of finance. How do people actually behave? All I've talked about in these series is about what the theory says we should do. Next year's series will be all about what do we actually do? How does the market actually work? So what have we done this year? 6 basic ideas in finance: NPV, portfolio theory, CAPM, capital structure, option pricing, asymmetric information, and market efficiency today. All the ideas fit together. If any of these ideas don't work, nothing works. Right? All have to work. That's why finance is so elegant. Everything fits together. But at its core, finance actually only has one big idea: no free lunch. Nobody gives you something for free. If you take that away, you will be a wealthier, more cynical human being. Okay. Thank you.
Thank you so much. We do have a few minutes for questions. So shall I take some from the floor to start with? Wave at me if you've got a question. Otherwise, I should go straight to Slido. Oh, here we go, over here.
My question is this. When a company wants to raise money, it sells rights issues, or it could, I believe, buy back shares. Why would the company choose one or both of those options? What are the parameters it works on when it wants to buy or buy back its own shares, please, instead of issuing a rights issue?
Okay. The answer there is it's also driven by information. The key is, as an insider in the company, that is basically the manager, you know more about the true value of the company than the outside market. So the moment you make a decision, I'm going to issue shares, or I'm going to buy back shares, the market makes an inference on what information you might actually have. If, for example, you believe the true value of the shares is £100, but the market thinks it's worth £150, what should you do? Issue as many shares as you can. Example, GameStop. GameStop has done this several times in the past. Every time the share price goes up because Roaring Kitty or somebody posts a meme, of himself, with a line or something, the price goes up. Immediately GameStop issues shares because he says people are willing to pay crazy amounts for my shares. I'm going to do this. So the point, of course, is when do investors realize? So it's a combination of asymmetric information and market efficiency.
I'll just take one from online. A couple of people online have asked a very similar question. One of them phrases it rather well. If publicly available information dissected by the best analysts leads to a coin flip probability, will artificial intelligence move the needle at all?
Artificial intelligence is very, very good at detecting patterns. It is considerably less good in telling us whether the patterns actually exist or they're hallucinations. So in other words, at the end, it's sort of like a Red Queen's race, I think. You have a bunch of hedge funds all using artificial intelligence to find patterns. You have another bunch of hedge funds using artificial intelligence to find their pattern. All these artificial intelligence companies are, basically, algorithms are battling each other. I myself don't invest in any individual company. All my money is in index ETFs. Right? I did, as I said, work for a hedge fund for 2 years. I joined on September 2008, the week Lehman went bankrupt. And I left, when the market started going up again. Perfect timing. But in that year, I figured out, really, it is like working in a Michelin restaurant and seeing how they actually cook the food in the kitchen versus how they bring it out to you. Looks really good. But seriously, I'm going to cook my own food. So I buy basically only index ETFs.
Excellent. Are there any other questions in the hall before I do? We've got one just over the front there. Wait for the microphone to get to you, otherwise people online won't be able to hear.
So would you consider the human factor in trading making the market more inefficient?
Okay, there are two parts to this, right? Part number one is about inefficiency in the sense of, is there a difference between value and price? Value is the value which we calculate using net present value and all the calculations. Price is the part on the marketplace. So if you're a market efficiency purist, you say the value must be equal to the price. If you're a different type of investor, you say there can be differences, and we can try to exploit that gap between value and price. The problem with market efficiency is market efficiency does not tell you how big that gap is or when the gap will close. For example, if you believe that this company is heavily undervalued and you buy it, and nobody ever believes you, ever, it doesn't matter how long you hold the share, you will consistently lose money, even though you may be right? So in other words, the market may not be efficient in the sense of price may not be equal to value, but it is efficient in the sense that you cannot predict which way the market's going to go.
I think we'll just take one more question from the online audience, if that's okay.
There's one more question in that corner over there.
This one's probably the gimme that everyone's wanting to know your take on it. What's your take on the future of Indian, British, and American stock markets for this year, considering the elections and the chances of world wars?
That is a brilliant question. And the answer is, if I knew the answer to the question, would I be here? Honestly, nobody knows. And I can tell you lots of stories, but most economist stories are best told looking in the rearview mirror. We can tell you, oh, that's what must have happened, but we cannot predict the future. Nobody can. So the answer to that question is, nobody knows.
And on that note, ladies and gentlemen, would you join me in thanking our speaker this evening for his fantastic insights, Professor Raghavendra Rau.
Thank you very much.
Okay, pleasure.